Hello, everyone. Today on the final bar, my guest is our own Grayson Roze, who's going to share with us some of the charts that are top of mind for him as the S&P continuing to pound away at new all-time highs. We were talking before the show about some of the mixed messages we're getting from breadth and sentiment relative to the price. But in the end of the day, we have to follow price. Cryptocurrencies, on the other hand, going full-on risk off today. We'll review all of those charts and more. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here in an overcast Redmond, Washington. Thanks for joining us every weekday after the close as we break down this market activity using the power of stock charts. Paul Montgomery, a legendary technical analyst, publisher of Universal Economics for decades, used to say the most bullish thing the market can do is go up. So if you're looking for signs of bullishness or bearishness, the S&P chart doing what it's doing, finishing at the highs of the day, pushing to new all-time highs, touching 4320. It is sort of all the evidence that you need that the market's in an uptrend. However, I think it's not just about what the overall market is doing. It's also about the components, the individual bets, the individual stocks and ETFs and groups and themes that comprise that market. When you look at that second level down, when you look at particular sectors, when you look at charts like the small cap growth ETF, for example, you'll find, it's not well. It's not like everything is going up and making new all-time highs. I think this is a time to be a stock picker, to be focusing on which trends are working and which trends are not. Hopefully on our show, we're able to help point you in the right direction. Now, we have great guests on the show, as always. I'm excited to talk to Grayson Roze here from StockCharts.com a little later in today's show. Coming up tomorrow, we will have no show on the final bar. Also on Monday, we'll be taking time off for the long holiday weekend. I wish you all a safe and enjoyable Independence Day holiday. Back on Tuesday, and we're actually at 4 p.m. Eastern, so we're moving the show back to live right at 4 p.m. right at the close. Look forward to having you join us there. Of course, our show will be available on demand later in the evening as always. On Tuesday the 6th, we have Tony Zhang from Options Play, and on Wednesday the 7th, Pat Saresna from the Market Huddle podcast. Also, as a reminder, we have our special mid-year event called Charting the Second Half. That's the entire week of July 12th. So coming up about a week and a half from today, featuring interviews with Martin Pring, Linda Raschke, Tony Dwyer, Gina Martin Adams from Bloomberg. I'll be giving a presentation. Then we also have a fantastic panel with Jay Woods, who we interviewed on the floor of the New York Stock Exchange, JC Peretz from All Star Charts, and John Kosar from Asbury Research. Should be a lot of fun with a lot of fantastic experts and strategists to help you think about how to regroup here at mid-year. And as we're finishing, going into our market recap here, as we finish the first quarter, begin now the second quarter, I think the question always goes to, where are the opportunities, right? What is the overall configuration of the market? And then where are the opportunities, sort of the level below there, right? How are you allocated to equities? And then how would you define that allocation? How would you specify that allocation? And overall, when you're thinking about stocks versus other asset classes, it's hard to think of anything but pro stocks at the moment, with the S&P up 0.5%, touching 4320 going into the close. The Nasdaq Composite actually lagged behind. The Nasdaq 100 was almost flat for the day, with the technology sector actually one of the worst performers of the 11 S&P sectors. Mid caps and small caps actually performed a little better than the S&P, which is a bit of a change. In recent weeks, we've had the mega cap sort of growth trade leading, and sort of everything else was following along in their lead. Today, a bit of a mean reversion on that. We'll get to the sector themes here in just a minute, but overall mid caps and small caps doing just fine. One of the stories today, and the reason why some of the growth sectors were down, or one of the implications, is the fact that yields have gone back higher. So the 10-year yield coming up from going down yesterday, back up to around 148 on the 10-year. And the dollar index, by the way, in the form of the UUP, is touching 25. And that stronger dollar theme is something we've been talking about. If you look at the relative performance of non-U.S. stocks versus U.S. stocks, maybe a better way to think of it, U.S. versus non-U.S., that's been trending higher, and that mirrors very much the trend in the dollar. However, the dollar's not up a ton off of its lows from earlier in the year, while U.S. stocks have certainly been outperforming non-U.S. stocks over that period. So worth paying attention to that ratio. Commodities sort of mixed today with oil prices going higher, energy, the number one S&P sector, gold up about 1/3%, and silver down. So sort of mixed messaging overall. If you're looking for the color red, the cryptocurrency page is a place to see that, with Bitcoin down about 5% from where it closed yesterday. Ethereum and others leading the way lower as well. So obviously plenty of volatility in the cryptocurrency space, but in terms of the trend, you can see this sort of overall rotation from accumulation to distribution phase. I would argue, I think there's still more, at the very least, backing and filling for some of those cryptos to have before all is said and done. Let's look at a chart of the S&P 500 here briefly and just check in on where the market is. When the market's making all-time highs, I'm often asked, what levels do you pay attention to? And there are a whole set of scenarios or tools that people use to try to project levels, Fibonacci projections, Elliott wave, Gann. These are all methodologies that are designed to help you anticipate turning points, that is, anticipate price levels. As you may know from watching the show with any regularity, those are three things I use very rarely. I enjoy very much talking with people who are experts in those areas, but for me, I'm much more of a trend follower, and I think that came from working for money managers who, when something was making all-time highs, they would never consider selling that because it's something that's helping them perform well. They're going to keep riding that out until proven otherwise, and it certainly appears that the path of least resistance for stocks has been to the upside. We're seeing the S&P making all-time highs last week. We're seeing another push to new all-time highs this week with the close around 43.20. We remain above the previous swing lows. So, the question is, at what point is the uptrend over? And my very simple response to that is it's when the market stops going up. And the way you tell that is by defining clear levels of support and identifying when they violate. Now, the most reliable measure of support, arguably, in 2021 has been the 50-day moving average. We've touched that in January, in February, in March, another time in March, two times in May, and now again in June. And the pullback that we had through the right to the 50-day in mid-June was the last time we've touched that. We very quickly reverted higher, and you can see pretty much every time we've hit the 50-day, the next day has been right back to the upside. That's the sign of a resilient market. That's the sign of people accumulating on weakness in price. And my assumption would be that pattern continues until it doesn't. At some point, people don't buy the dip. At some point, people take profits and no longer supply upside buying power. That's when the uptrend is exhausted. It's not today. Another interesting read on the S&P chart, by the way, from my opinion, is looking at the momentum. So in January, February, March, you had this bearish momentum divergence, new highs in price, lower peaks in the RSI. That changed at the end of March when the RSI broke out of that pattern and made a new momentum high as it made a new price high. And I think that's exactly what we're seeing again in the last week. We saw lower peaks in the RSI April, May, June. We saw this momentum divergence now break, and the RSI has gone back above 60, back above the previous high. So, by all measures of the chart of the S&P, the path of least resistance certainly seems to be higher. And I think positioning yourself for that reality is totally fair. I would argue the most important thing you can do is not as much what is the S&P itself doing, but focusing on your particular positions, because there are charts that are managing to break down, and make sure you're aware of that and position correctly for that. Going back to the main, our main dashboard, if we look at the sector returns, you can see energy led the way today. It was followed by utilities and healthcare, 1, 2, 3 at the top. So, energy is an interesting sector, had been certainly leadership, but gave a lot of those things back, with charts like Marathon Oil come to mind. We can bring that up very quickly. If you look at MRO, this is a good example of what the chart of the XLE, to be honest, looks very similar to this. Pulled back to the 50-day in March, made a new swing low in April, but it never really undercut the March low, then returned right back to the upside, powering through to new highs, a higher low, and now once again rotating to make a new 12-month high again today, up about 4% today. Marathon Oil is one of the top 10 S&P stocks. I was looking earlier today actually at the year-to-date returns in the S&P 500 members. 5 out of the top 10 are all in the energy sector, if you haven't looked at that yet. So energy, the number one sector, followed by utilities. So if it felt like today was an offense, shoot the lights out, go higher move, not necessarily. Utilities are kind of a boring defensive sector, high dividend yield paying sector, but managed to be the second best performer, followed by healthcare, and then financials, and higher rates certainly tend to be a tailwind for the financial sector. On the downside, you had consumer staples leading the way lower. It's the only one of the 11 S&P sectors that were down today. After that, it was technology and real estate and consumer discretionary. So the growth trade has certainly been working in recent weeks. The growth trade, even through Friday, certainly, at the end of last week, doing just fine. This week so far, holding up very well. Today, a bit of a rotation back, and some of those stocks like Tesla or ETFs like the ARK Innovation Fund pulling back a bit today, but overall still in a decent uptrend, continuing to manage to push to new highs as needed. Let's look at a chart of Bitcoin very quickly. So I'm going to go to the asset allocation view. So here's the chart of Bitcoin. And I find when the trend is difficult to read at any point, the best thing you can do is take a step back and just look at the overall configuration. There's no doubt looking at this chart for the last year that you've seen a clear rotation from an accumulation phase through the April high to more of a distribution phase. And I have confidence in that thesis by the fact that we went from a pattern of higher highs and higher lows to a pattern of lower highs and lower lows. And I think the low in April and then the lower high in May was a pivotal moment, and breaking below that last area of support there, the April swing low below 50,000 was significant. At this point, certainly seems to me like the path of least resistance is lower as you continue to see the bearish momentum divergence that we're no longer seeing with stocks. We need to take a quick commercial break. We'll be back with my guest, Grayson Roze. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. Thank you so much for joining us every weekday after the close for our show. As a reminder, we'll be back at 4 p.m. Eastern starting next Tuesday. Look forward to having you back after the 4th of July weekend. A couple quick comments before we get to my guest, Grayson Roze. First off, send us your questions at the Final Bar mailbag. Our email is thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. We're on YouTube. Just put a comment below the video that you're watching. Again, we love to hear from you, particularly questions that come up during your own process of analyzing charts of interest. Shoot us an email with any questions that come up, and we would love to answer your question in our next mailbag segment, which will be on Tuesday's show. Also, as a reminder, go to stockchartstv.com. Use your email, set up a free account. You can start watching all of our great content from fantastic guests like Grayson Roze, hosts, and great shows like The Final Bar. Also on all your mobile devices, just look on your app store for StockCharts TV on demand. I want to welcome on my guest, Grayson Roze. Grayson's the VP of Operations here at StockCharts.com. But besides being one of the drivers of development for StockCharts.com, he's also a trader, an investor, and a very capable technical analyst. Grayson Roze, welcome back to the show today. It has been a little while, and it's always good to have you on. When we were talking before the show, we have this challenge right now with, in some ways, the S&P just pushing to new highs. But depending on what you're looking at, you get different messages, right? Depending on which chart we're sort of focusing on. You sent a couple charts ahead of time. We're going to start with the NASDAQ composite. What are you seeing with a chart like this making new all-time highs?
Yeah, well, so as usual, you told me to bring two charts. I kind of cheated, and I put like 5 to 10 on both of the two charts that I brought. So we got a ton of things to look at here, but I think, ultimately the theme that I wanted to talk about, that I'm a Seattle guy through and through, but I just got back from a trip to New York. So I'm going to put on my New York accent, and I'm going to tell you that growth is coming back, baby. It's coming back. So here what we're looking at on the NASDAQ, something that I've been watching for months now really is this kind of rising wedge that we've seen in the NASDAQ, testing that top about twice. We've got higher lows across the bottom, and we finally made that breakout on the NASDAQ. It had been lagging for quite a while, but where we're sitting right now, we've made that breakout to new highs. We're kind of trading around new highs on the NASDAQ, coming out of that rising wedge. I think that is incredibly bullish. So that was one thing that I've been watching, but sort of in concert with the other couple of things on this chart. Now, the weakest point on this chart is the advanced decline line, like you were talking about earlier. But I am watching that trend line break as this starts to move higher. So if we can see this NASDAQ advanced decline line get back to new highs, we can start to see a little bit more participation come in. That, I think, is going to be incredibly strong for the NASDAQ. Obviously, a heavy growth-oriented index there. And so ultimately, the thing that I'm talking about here with growth coming back, this is something I've been watching really, really closely is in this case, we're looking at the Russell 1000 growth versus value ratio. But ultimately, a lot of people have been talking for months now about the outperformance of value, the underperformance of growth. And we're seeing that really start to turn around. When we look at this ratio, especially over the last kind of 2 years, what we've seen is this incredible outperformance of growth on the front end. And we've come down really to sort of prior resistance turned into support for this ratio. And now as we're moving higher, again, I'm looking at that trend line break and seeing growth start to outperform value. Pockets of the market that were working really last year that have been lagging now for a couple of months, those are starting to sort of pick up pace and start to outperform the rest of the market. On top of that, we've got the ratio at the bottom, which is the equal weight actually. Offense versus defense. We've got consumer discretionary versus consumer staples. So when we're trying to think about growth versus value, offense versus defense, NASDAQ leadership, all of that kind of thing, basically the sort of the risk on trade, I'm seeing a lot of these ratios, a lot of these, advanced decline lines in the NASDAQ itself moving higher, which gives me a lot of confidence that growth really might be coming back. People might have, sort of taken a pause for the last 9 months, let value run, but now we're starting to see this stuff really pick up. In the other chart that I brought today, we're looking at a couple of these specific groups, a lot of those kind of themes that were really, really powerful in 2020, a lot of the stuff that really worked, but has taken a hit for the last 6 to 9 months or so. But now, again, we're seeing a lot of that come back. So we've got semiconductors, which is that orange line. We're seeing that making new all-time highs. We're seeing things like cybersecurity making new highs. That's the purple line. We're seeing online retail making its way back up there. Again, another trend line break there, but outperforming the market. And even something like biotech, which obviously was a big growth theme last year, we're starting to see biotech moving higher again, outperforming the market a little bit. So down below, we've got actually the ratios of all of those groups versus the S&P 500. But again, I'm kind of watching a lot of these 2020 themes that have started picking back up. The pace has picked up. We're finding new highs in things like semiconductors, things like cybersecurity, really kind of risk on aggressive corners of the market. So I'm watching all of that. And I think this is really kind of a bottoming process for growth versus value. And we're seeing it come back into the market.
Those charts tell such a great story, Grayson. I love the illustration with the ratios here with consumer, within consumer, but then also, the relative performance of some of these key groups. How do you reconcile that with sort of the seasonal challenges that we're in, right? We're supposed to be in the seasonally weakest part of the year. We're told to sell in May and go away, but we see the market moving higher and some of this growthy stuff continue to work. How do you reconcile those two things as an investor?
That's a great question. We get that a lot with seasonality, right? And people want to rely so heavily on it and say, this is the seasonality, so it has to happen. But ultimately, like you said at the start of the show, Dave, I mean, we have to be price followers. We have to be trend followers. We have to just listen to what's happening on the charts and take seasonality as kind of an input as a data point, but then weigh that against what's actually happening. And so when I'm thinking about the seasonality, it's in my mind. It's something that I'm considering. I'm saying, wow, this is kind of interesting relative to the seasonal tendencies that we have in the market and in some of these corners of it. But at the same time, if the charts are telling me that we're moving higher, we're outperforming, some of these growthy segments of the market are leading, I've got to follow that.
It's a great take, Grayson. I appreciate you, as always, bringing charts that are humbling to me because it demonstrates your command of the StockCharts platform, much greater than my own. But it's always awesome to have you on. Listen, be well, stay safe. We'll talk to you again soon, all right?
Thanks, Dave. Great to be here.
That's Grayson Roze. Grayson is the Vice President of Operations here at StockCharts TV. And again, what I love about working with guys like Grayson is besides what we do at a place like StockCharts, at the end of the day, we look at a lot of charts every day, and having someone like him that we can chat about, that was a microcosm of one of the many conversations I love having with someone like Grayson. I hope what you noticed, which is what I did, is his use of ratios. We talk about ratios often on the chart or on the show. And I love that ability to differentiate between different pockets of the market by focusing on relative movements, right? A group or an ETF versus the overall S&P, but also looking at two ETFs like the consumer staples versus consumer discretionary, something like that. But a great take and certainly highlighting the strength in the growth trade. Our next segment is called Getting Sentimental. We love to do on a Thursday is focus on the sentiment readings and see how things have updated a bit. A lot of the sentiment data comes out Wednesday into Thursday, so it's sort of a natural time to do so. We talked a little bit about breadth. I didn't get into it too much with Grayson, but I mean, one of the concerning or one of the issues I have, we talked about the Nasdaq advanced decline line. I think if you look at the mid cap or the small cap advanced decline lines, you have that same issue where you're not quite confirming new all-time highs yet. Now, the reality is you could certainly do that, but we haven't seen it yet. So breadth is another piece of the puzzle that helps us make sense of things. Sentiment for me is sort of the third piece. You have price, then breadth, then sentiment. And this is where you get into things like options data, survey data, what else? Positioning data, and you get to get a good assessment of how people are voting with their words and how people are also voting with their feet, which is arguably more important. You know, a quick look at the VIX shows you whether we are at the lowest levels in the VIX really since the February 2020 market top. Now, that's a bit misleading. I don't want to say misleading, but if you assume that, you know, we're at a top because we're where we were in February 2020, I think you are missing the point of the volatility index that we're using here, right? The VIX is not bound. It can fluctuate and it can actually change over time. So there have been periods when the VIX actually ranges from 10 to 20, which is what we saw for most of 2019. And really until the February 2020 market high, that was sort of the range that we saw for the VIX. It was a fairly reliable indication of when the market was overextended on one side or the other. That all changed in the first quarter of 2020. Now in 2021, we've settled back into a bit of a lower range, and we're, but again, for this point, we're actually at the lowest level that the VIX has been. When the market has pulled back, the VIX has spiked up above 20, and I think that's an important upside measure here. The last couple pullbacks that you've seen here in May and then again in June, you saw the VIX spike up to well over 20, almost up to 28 in May, and then spike up to around 20. We're back now just around 1540 or so, which again is the lowest reading that we've had. There is no defined floor to the VIX, and if it is, it's well below where we're at right now. Having said, it's worth noting that the volatility is at the lowest level that it's been. The AAII survey took a bit of an upward turn this week. So last week and really the last 4 weeks, we've had a relatively bullish but stable AAII survey. This is a survey of individual investors. It was hovering around 41% bullish, which basically means out of all the respondents, 40% responding they're bullish on stocks for the next 6 months. In the last week, that number has actually increased fairly dramatically up to around 49%. Now, the back of the envelope level that I tend to look at is 50%. If we're above 50%, that tells you that we're no longer bullish, in my opinion, but more euphoric. We're at the level where sort of everyone's all in. They've made their trade. They've bought in. And the concern is who's left to push the price higher. Now, you'll notice, though, in the last year, you've had a number of times where the AAII survey got well above 50%. Noteworthy here in the early November 2020 point and also the beginning of April of 2021. Both of those times, actually, the market continued higher. In the end, pulled back in some of those cases, but overall, it's an indication of potential overextension. The spread between bulls and bears is around 26% right now. Our next chart is looking at the name exposure index, and this is an interesting one as well. 2 weeks ago, we were almost at 100% long. Last week, we came down to around 70% below that of long reading, and now we're at 92%. This is a survey of money managers and asking whether you're 100 or 200% long, 100, 200% short, or basically 0% long equities or 0% equities exposure. This week, the reading is around 92%. So for me, above 100% is telling us we're overextended. We're really, really close. So with two of these sentiment measures, the AAII survey and the name exposure index, we're not quite at the overextended point, at the euphoric point, but we're really, really close. So the S&P moving to new all-time highs, the Nasdaq moving to new all-time highs, the sentiment readings inching ever closer to the euphoric level tells me to be looking for that. And at that point, to start thinking about potential topping patterns or signs of negativity. The RIDEX flows, by the way, are at the lowest level that they've been back in the deep history of this series. It's around 0.08. And if you look back through the long history of that series, excuse me, 0.08 is the lowest reading that we've ever had, or right about at that lowest level. And that indicates basically that individual investors are all in bullish using the RIDEX funds, the bullish versus the bearish or cash portion of that fund family. Finally, we finished off with put-call ratios, and we're going to look at the equity-only put-call ratio. The total put-call ratio is another way we can look at it. That includes some index options as well, but we're going to look at the equity put-call ratio. So it is not at the lowest level that it's been. So if you look back in December, And in January, I remember highlighting this chart and recognizing that we had broken below the previous support levels for this this uptrend since the March 2020 bottom. We're not there yet, right? So actually, we were lower earlier this month, earlier last month in June. We were around 0.4. We're now just above there. But overall, this is a chart to certainly pay attention to as you see some of these sentiment readings get to their euphoric levels, indicating that investors sort of are anecdotally all in, and the question of who's left, if all the buyers are in, who's left to push the price higher. We're not quite there on the put call ratio or some of those other sentiment readings, but these are the charts to watch to see whether or not we actually get down to those points. Again, as I mentioned, I think it's worth noting that in December and January and February, which is the last time we were in sort of this bull market that just keeps making new highs once a month, we make a new monthly high. That's actually the beginning of the trend that we're arguably still in. Much higher levels or much lower levels in the put call ratio, arguably making some signs of overextension. Not seeing it here just yet. That is our review of the sentiment readings of the day, called Getting Sentimental. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the S&P 500 breadth by cap tiers. Excuse me. When we look at the breadth by cap tiers, you can see the S&P advanced decline line, which is the second panel down, has made new all-time highs in the last week, as the S&P 500 itself has made new all-time highs. But if you look at the common stock only NYSE advanced decline line, lower highs. If you look at the mid cap AD line, lower highs. If you look at the small cap AD line, lower highs. Now, again, that's fine. If the S&P keeps going higher, I'm going to tell you that the S&P is in an uptrend until proven otherwise. But these are the signs of breadth divergences that can be a bit concerning, right? With the S&P going higher and the advanced decline lines making new all-time highs, that all makes sense. When that stops happening, for me, that's more of a red flag, and to pay attention for potential divergences. And what it does, I think, what it recognizes in recent weeks is sort of it's the Facebook's, the Alphabet, sort of the mega cap growth trade that's really been pushing higher. Some of the other stocks have not really participated quite yet in the uptrend. Chart number 2 for the 3 and 3 is borrowed from Grayson Roze's charts. So he did a fantastic job of showing how we can line up a lot of different indicators on one chart and look for confirmation, agreement, disagreement. This is one of the indicators or one of the ratios that he had on one of his charts, looking at the consumer discretionary versus consumer staples ratio. On the top, it's the cap weighted version, which is using the traditional ETFs, the XLY and XLP. At the bottom, it's the equal weighted version of that, looking at the RCD and the RHS. Both of these have broken above trendline resistance. If you take the highs from earlier this year, connect them with the trend line, we've broken out of above that trend line. The equal weighted version is close to making new all-time highs in that ratio. So what it indicates is overall within consumer, people are leaning more onto the offensive side than the defensive side, and that's certainly a sign of market strength overall. The last chart in our 3 and 3 is the energy sector, ticker XLE. And this is one of the charts we look at when we're reviewing the 11 S&P sectors. We usually start with the RRG graph and then look at some of these individual sector charts. Energy is an interesting one. If you heard Grayson Roze's comments a number of times, he talked about resistance becoming support, things like that, which is a very classic tried and true technical approach about the meaning of particular price levels. And I would argue on the chart of the XLE, we're kind of seeing that. If you look at the March high, and then the pullback to the 50-day, a bit of a break below, but holding at previous support levels, then a rotation back higher. We've hit resistance there a number of times, right around the 53 level. Then the XLE broke out and now has retested that level a couple times from above. Overall, as long as that support level holds, as long as the 50-day holds, this chart certainly seems to be setting up in a pretty decent direction. So now I'm faced with, where do we lean into? Do we lean into the growth trades that is working? Or that are working, or do we lean into something like the XLE that's been lagging a little bit or not really leading the way higher, but really setting up for potential higher highs? Arguably, we can own all of those by going into a benchmark fund, but I will be very keen to see if energy and some of the other cyclicals are able to hold their previous support levels. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. As a reminder, next Tuesday after the long 4th of July holiday, we'll be back at 4 p.m. Eastern live. We'll also be on demand later in the evening, so we'll look forward to having you join us there. As a reminder, go to stockchartstv.com and check out our content there. For stockcharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend.
Hey, Grayson Roze here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.